we still think that there is risk to the upside. The thought of elevated production, we think that's fairly well digested. If we get some quick turn to colder weather in certain key hubs, like we saw earlier this month, you could see that spike higher. So we're still confident that we're going to see somewhere closer to 5. Because again, we think the risk is to the upside.
Right now, data centers are adding something like half a BCF per day of demand to the overall mix out there. And so, if you're looking out over the next 4 or 5 years, by 2030, you might be adding 2.5 BCF per day of gas demand from data centers.
Even 2.5 BCF a day is extra throughput to carry. Companies could touch it at multiple different points behind the meter projects connected to utilities, but Kinder Morgan, TC Energy, Williams Energy Transfer are the 4 names that come to mind because they're primarily focused in Texas and Northern Virginia, where most of this is.
So it's a direct link between the wellhead and the server rack, and it essentially locks in multi-year demand visibility right in that Marcellus footprint that they have in the Northeast. Range and Expand are also positioned to benefit from this AI and data center dynamic. These operators are sitting on low cost gas supplies in Appalachia.
Production has been extremely elevated. And so we did get that. We were off on the production side of the equation. We're looking at somewhere between 5-6 BCF a day higher year over year. And that's pretty robust when you consider that we really haven't seen growth overall on the liquids.
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got our gas crew from North America. So starting with Wilmington, we've got Vince Piazza joining in a very lovely vest that you'll see momentarily. Then swinging up to Princeton, New Jersey, we've got Talon Custer joining. And then in our 731 headquarters at 731 Lexington Avenue, we've got Matt DiMarino. So that's the folks for the call today. And like I said, we're going to be chatting about gas. We've got quite a few provocative notes out on the sort of space here at the moment. We've been taking a look at the intersection of AI and data centers and what that could mean for gas demand. Of course, Talon's always on the ball on what's going on with the LNG market. And I think we'll start with just the commodity outlook because, Vince, you and Matt have a focus idea on the winter gas outlook. So I would like you to sort of give us the details on that. Where are we at today, and where could we see Henry Hub flow to this winter?
Yeah, so we had a update to our focus idea that we had out earlier in spring. So we tend to look at this as a seasonal thing for us on the natural gas side. We put out a summer focus and we put out a winter focus. The summer focus took us through injection season into the early part of winter. And it's interesting, you've seen considerable volatility in the underlying commodity. We did breach over $4 in June, and then we just sold off hard to below $3. We came back pretty strong to almost $3.50 in October as weather began to turn, and now we're sitting once again closer to $3. So intermittent volatility, which is to be expected during the what we call the shoulder season, right? As we get ready for winter, as we pass the peak of summer in July and August. Where it stands for us is we tend to look back and say, what did we get right? What did we get wrong? And where do we still see the opportunity set? Production has been extremely elevated. And so we did get that. We were off on the production side of the equation. We're looking at somewhere between 5-6 BCF a day higher year over year. And that's pretty robust when you consider that we really haven't seen growth overall on the liquids side. So on the demand side, though, it's been pretty good. I mean, despite the lack of strong summer heat, the demand side of the equation has been pretty good, and that's because of Towns' LNG feed gas demand has been relatively strong year over year, and so that's been helping us out as we think about heading into November and December. We still think that there is risk to the upside. The thought of elevated production, we think that's fairly well digested. If we get some quick turn to colder weather in certain key hubs, like we saw earlier this month, you could see that spike higher. So we're still confident that we're going to see somewhere closer to 5. Because again, we think the risk is to the upside. The downside is pretty well digested. As we head into the start of the winter draw season, we think the storage will be threatening 3.9 Ts, which is considerably higher than what we thought. And of course, obviously, it's really more of a function of elevated output as opposed to the demand side. So if we can get that more under control, and we think we will be getting that under control because, quite frankly, we have a logjam of bottlenecks on the pipe side. So especially down in the Permian in Texas, as Matterhorn has been pretty full up at this point. So we are still optimistic. We think there's risk to the upside more so than the downside. And we'll be putting out our winter outlook for natural gas in the next week or so. A quick, Rob, a quick commercial for us. We will be hosting a webinar on November 6th. And a roundtable in New York City on November 6th as well. Happy to add the webinar link to this, but hit us up if anyone has any questions, and happy to chat about that or other things related to natural gas.
Yeah, November 6th. Write that date down, folks. I'd love to see you in New York. Vince, just give me a quick sense. Very interesting overview on the fundamentals there. I'm curious to get your read on full cycle production costs. Just vibe check it for us. What are the producers sitting at these days? Are they making a lot of money or a little money at $5 gas if your sort of vision plays out?
So the pure play gas guys, they've really gotten their act together from a cost perspective. They're doing all of this without much rig count growth, without much completions growth. So they have really come down the cost curve, especially in Appalachia and especially in Haynesville. So it's been fairly significant. The thing to look for is, of course, Waha pricing, and that's been relatively poor, just given the bottlenecks, and Town can offer more commentary about that. But in general, if you think about budgets, budgets for 2026, because basically we're done with 2025, right? Budgets will likely be underwritten at a 60-65 handle and $2.50, $3 gas. But when I say budgets underwritten at that level, we're talking about maintenance budgets, right? We're talking about enough capacity to replenish or replace what was lost. So those decline curves, right? Replenish and replace what was produced last year with a little bit of growth going forward, but we're not talking about exponential growth. In fact, I'm quite surprised that we've seen the type of growth that we saw, but it's mostly been exclusively on the associated gas side, which should decrease in 2026 because like I said, what Town will tell you, that there's really not a lot of greenfield capacity coming on in Texas to stoke up all of that natural gas.
All right, so perhaps one of the bright spots of an area that could soak up the natty gas is data centers. Now, you've already mentioned LNG, but let's just quickly dive a little deeper on that topic. And I think the whole group of us, we've all sort of been talking about it because it's in the zeitgeist here at the moment. And the way I kind of think about it at the highest level is that right now, data centers are adding something like half a BCF per day of demand to the overall mix out there. And so, if you're looking out over the next 4 or 5 years, by 2030, you might be adding 2.5 BCF per day of gas demand from data centers. I know it's probably a smaller share versus what LNG could do. But Talon, let's come to you first, because I know you've got a note out this morning that's quite interesting that frames what this opportunity potentially means for the pipeline names. So give us a sense of what you're thinking there.
Yeah, so first I would say a lot of the larger companies can benefit from this. Even 2.5 BCF a day is extra throughput to carry. Companies could touch it at multiple different points. Behind the meter projects connected to utilities, but Kinder Morgan, TC Energy, Williams Energy Transfer are the 4 names that come to mind because they're primarily focused in Texas and Northern Virginia, where most of this is. So, it's again a couple BCF. It's decent growth, but it's nowhere near what LNG is going to be. But the behind the meter thing is kind of interesting. Now, a couple of companies, Kinder Morgan, DT Midstream, have said that it's mostly on the regulated utility side that the interest is coming from. But there have been a couple behind the meter projects. Williams has 3. 2 we don't know the location of. One is in Ohio, so to capitalize on Appalachia gas and provide an outlet there. Energy Transfer has a tentative deal with Cloudburst in Texas. So, those are the catch the headlines there. But those 4 companies, I think, will be the primary beneficiaries of it.
Can you give me a sense, Talon, of what you're seeing the companies say about the potential opportunity? So the estimates are all over the map. I think we're kind of in a pretty consensus-y trying to say, look, around 2.5 B a day by 2030, maybe as low as 1 up to 5. But goodness, I think it was EQT that was talking about 18 BCF per day by 2030. So this just is it's a very uncertain concept. Give me a sense of where the industry players are. How does that reconcile? Are folks going to get disappointed? Do they think that this is a bigger opportunity than it really is? Yeah, just read the tea leaves for that a little bit for us.
I think the companies in my space have really tempered expectations from last year. Last year it was more like 2 to 10 BCF a day by 2030 was the estimate. We've seen some companies come down. One, I believe it's Enterprise Product Partners said 3 to 5 BCF. Targa was just citing someone else's research, said 6. Kinder was the one that put out like a 3 to 10, but they've even come down and said they expect gas-fired power demand to increase by about 3 BCF a day from 24 to 30. More interesting commentary around, again, if you build a lateral directly to a power plant, or you're doing a behind the meter project, you know exactly where the gas is going. But a lot of these projects, if you're just doing an expansion of a network, you don't know exactly what it's going for. So Kinder, for example, has a $9.3 billion project backlog, and about half of that, they said, is actually focused on power projects, but only let's call it a fifth of that, or a quarter of that may be directed toward data centers. There's a lot of growth still from coal to gas switching and power in general. The Southeast, for example, population growth, getting away from coal. So it's not even just data centers that are driving power demand. It's the other aspects of it as well. But I do think overall, the figures have become much more realistic and in line with what we were kind of, last year when we saw 2 to 10, we put out a couple notes as a team that said maybe like 2 to 6, somewhere in that neighborhood, closer to the lower end. So I think they're far more reasonable. But that's not to say that demand can't grow after 2030, right? 2030 is not that far off. So after that, there could certainly be more.
Thanks, Dallin. Matt, I want to get you into the conversation here because, the last time you were on, we talked about this topic in passing, and you were particularly looking at the AI opportunity in the Appalachian region. So I want to give you the same question that I was just asking Talon. What kind of ranges are you seeing out there for this opportunity? And, how key is the outcome for the gas sector being driven by all of this excitement around data centers?
Yeah, thanks for the question. Roughly in our analysis, we're pointing to somewhere between 1 to 5. That's a generally safe range, 2.5 BCF a day of gas demand as a midpoint. And from the upstream and integrated side, I mean, AI is really shaping up to be a new source of structural gas demand. What we're seeing is, that data centers are power hungry in a way that's really different from the traditional industrial or residential loads, because these sites need 100% uptime, 24 hours a day, and that kind of reliability is still overwhelmingly leans on natural gas, even with the growth that we're seeing in alternative energies and storage. So for the upstream players, EQT specifically really stands out as an early mover. So they've signed one of the largest gas supply agreements that we've seen. That's tied to a 4.4 gigawatt data center campus that's being built in Pennsylvania. And that project is designed specifically around AI computing. And EQT is going to be the anchor fuel provider for that project. So it's a direct link between the wellhead and the server rack. And it essentially locks in multi-year demand visibility right in that Marcellus footprint that they have in the Northeast. Range and expand are also positioned to benefit from this AI and data center dynamic. These operators are sitting on low cost gas supplies in Appalachia, right where a lot of that new power infrastructure is expected to come up. Range specifically is developing their own power plants. That's with ILC and Liberty. That's going to be in Fort Cherry, and that's meant to be marketed towards data centers. So you have other EMPs also breaking into the fold. When you move up to the mega caps, we're starting to see companies like Chevron, Exxon taking a little bit more of an integrated approach. Chevron partnered with GE Vernova Engine 1 to develop 4 gigawatts dedicated gas-fired capacity, and that will directly supply data centers behind the meter. And that gives them flexibility on pricing, gives them reliability, and it keeps them close to that AI ecosystem. For Exxon, they're pursuing a similar concept. They're layering in a bit of carbon capture. So they've outlined around 1.5 gigawatts of plant capacity that could also serve data centers while keeping emissions low. So what's happening is that AI is effectively giving natural gas a second life, and maybe not just as transition fuel, but as a backbone for powering these data centers for the next few years. Upstream, it's going to be those long duration demands that supports their production and pricing. For the integrated majors, it's a chance to turn their gas production into a more vertically integrated power solution. So a lot of interesting stuff happening. It's very important for the gas story, this AI build out, but a lot yet to come.
Yeah, it's very interesting that you mentioned carbon capture and storage being pursued by Exxon in the context of AI. I think it's worth keeping in mind that most of the hyperscalers, if they really had their wish list, they would probably prefer to not use gas or any sort of fossil fuel. It's sort of a reality of the moment, and I think they're somewhat begrudgingly using it. And just looking at the screen here today, it looks like New Scale SMR ticker is up close to 20%. Oklo, another nuclear related name, up close to 10%. I don't know if there's any specific news, but I think it's sort of part of this AI theme. You've really seen it come into the nuclear space, and there's just lots of excitement there. So Vince, these are big day-on-day jumps in some of the nuclear-related names,
Yeah.
all on this AI story. Is there any chance we're going to see that kind of euphoria or enthusiasm on the gas side, or do you think that the investors and the traders in the gas space are just more level-headed? They've got their head around the opportunity, and it's just not the same kind of potential.
I think in general, you are correct when you say that they begrudgingly look at gas as the needed evil, right? Because this is still a group that would prefer to have the wind, the solar as the key source. But that's just where they're putting this stuff is not conducive to having that full time, right? So that's why when I take a look at these estimates, I view them much more skeptically because it's not going to be the main source gas, right? What we haven't discussed, and I'm sure if you get Scott on the line, he'll tell you about this as well, but the backlog, the equipment backlog that exists right now to help build out the infrastructure piece is significant too. So there are a lot of unanswered questions at this point, and that's why I stick to my view that 1 to 2 seems to be a much more reasonable assumption. I'd rather be surprised to the upside as opposed to disappointed and have to revert estimates down to get myself back into a more realistic mode. So I think I'm pretty comfortable with that. Is there going to be a small nuclear reactor? Rob, every time I get that question, I go to Netflix and I tell them, take a look at the 3 Mile Island documentary, and then we'll have that discussion, right? And I think that's front and center on people's minds, especially those who, you and I are almost the same age. We still remember that scenario, and it is the best source. I mean, we're talking about the cheapest source of fuel that is the most reasonable cheapest source. Is just good luck trying to convince people of that reality. But I think there's more to come on this. I think gas will have its day, but I think gas will have its day on talent side of the house as opposed to the technology side of the house.
Well, of nuclear things to watch, I would say the one on Chernobyl that was probably, I think it was HBO. That one is a fascinating watch to go through what went on there. And for anyone who missed last week, we did have Scott and the team on to talk about nuclear. I think we ended last week's call with sort of going down the line, predicting when the first commercial SMR might be online in the US. And basically it was like mid-2030s, I think was the consensus view. So that leaves a lot of runway in my mind for gas, but solar and battery storage are quite interesting as well, right? Like they're the ones that can move most quickly. There's not a multi-year backlog on getting the turbines like you've got with gas. But Talon, I think this sets you up for an interesting cue because you've got a recent note out talking about the export opportunity for LNG. Okay, so we've already bucketed AI in a sort of more conservative 1 to 5 B a day range. What is LNG going to do over the next 5 years, and is U.S. going to maintain its dominant and newly crowned role as one of the world's big LNG export players?
Yeah, U.S. is the largest LNG exporter in the world, and that gap's just going to widen into the early 2030s. We've had a handful of FIDs. I see feed gas averaging about 16 BCF a day this year, and that's going to more than double to 35 BCF a day in 2032. And it could be higher if more projects, come to fruition. So that's a ton of gas. It begs the question of, is there enough infrastructure? Is there enough production? I think there's enough pipeline infrastructure to address it through 2028, but we're going to need more after that. I know Vince brought up the topic multiple times of constraints in the Permian, and we're going to have about 3 BCF a day of capacity coming online in the middle of next year, and another 1.5 at the end of the year to, hopefully help relieve that Waha Henry Hub differential. But we're going to need more, and it's not Permian has a pipeline being built to the west in 2029. So it's not all the Permian. There's a couple projects in the Haynesville, either ramping up or being built, but we're going to need more from Appalachia. We're going to need more from Eagle Ford. And right now, when you factor all that in, I think there's about 12 BCF a day of pipeline capacity through 2028 to feed LNG. But you have about 19 BCF of a day of feed gas. So there's a gap there that we're definitely going to need some more infrastructure. And then on top of that, the production. And that brings up the question about what price do we need in natural gas to motivate that production? A place like the Haynesville is gas focused, but has a higher break even. You need certain oil prices to, spur the Permian producers to get that associated gas. So there's a lot of uncertainty surrounding that, but I think it centers around what the natural gas price needs to be through the latter part of this decade.
Can you give me a sense of how you're reading the tea leaves on global gas price dynamics? Vince, I don't think this is Vince's long duration view, but he talked about $5 gas this winter, and I think there's a seasonal component to it. But let's say there's an equilibrium gas price that's a little higher than where we've been in the U.S. Is U.S. gas still competitive? Is there a point where gas prices could go in the U.S. where some of the buyers or market participants would say, no thanks, we'd rather not go there? Give me a sense of how competitive we are and what Henry Hub needs to be to make it all work.
Yeah, I don't know the exact answer to that, but I would definitely say over $4. Maybe $4.50 is a decent estimate. I don't know if that's enough to spur all of the gas that we'll need. Something in that neighborhood, but there's a lot of variables in there, right? So you have an LNG supply glut coming online over the next handful of years. I think that's going to bring global prices down, but it's also going to spur demand. You have a lot of price sensitive countries over in Asia, India, Thailand, Pakistan, Bangladesh, that I think China, demand will be boosted over there if prices come down. So I think a lot more will be absorbed, right? And then you have to factor in the contracts. A lot of US LNG is backed by long-term contract, even the projects being built. But there's some that are moving forward without that capacity contracted, and that's where it becomes iffy. So you have to factor in, if US is $4.50 and European prices come down to $8, you factor in shipping and regas costs, that margin narrows. So there's definitely, a certain level that prices have to be to make it work. And it'll be extremely interesting to see how it all plays out. But I do think that there is room for a lot of the supply to be absorbed.
All right. Well, we're here at the half-hour mark. These calls always go so quickly. But to close us out, why don't we take a moment and just reflect on the 3Q earnings cycle, which is either just kicking off or about to kick off, depending on which names you're looking at. So, Talon, let's start with you, and just give me a sense. What are the enduring themes we're going to hear discussed on the 3Q earnings cycle?
So, then excuse me, the names I cover are less sensitive to commodity prices. But with that said, still is some sensitivity, right? Companies with gathering and processing focus or marketing businesses will be hit by that. Oil's lower, natural gas is higher on a year-over-year basis, but it fell sequentially. NGL prices are still pressured, so we'll see that. I think it's more subdued. I don't think it's going to be the beat and raise of prior years. Maybe falls within the range of guidance at the lower range of EBITDA guidance for the year. Something along those lines, but I do think that the longer term stories are intact. We still see, the mention of AI and data centers. You hear about LNG, you hear about exports to Mexico. It's that natural gas, longer term demand story for those companies that are more focused on gas than oil. We're seeing higher spending on projects. I think CapEx as a whole will come down next year, but a lot more spending to try and capture that growth in the coming years. But overall, 3Q should probably be pretty subdued because of the commodity prices. Larger Canadian companies, the ones that are, like a Williams or a Kinder Morgan, are more in line with the natural gas, but the Canadian ones are more defensive because they have a lot more, regulated cash flows that aren't as affected by commodity prices.
Thanks. Matt, let's get you to weigh in here. Give us a sense of what you're expecting to hear as we enter the 3Q cycle, and how some of your Appalachian E&P geared names are going to be, what are they going to be talking about?
Yeah, so for the upstream group this quarter, the story is really about discipline and maintenance mode rather than huge growth. So most producers are still running their business for free cash flow, not volumes, and they will curtail those volumes if it means preserving that free cash flow figure for shareholder returns. We're likely seeing some seasonal production uptick heading into the winter. But mostly you'll see a focus on cost and trimming down the income statements to be a little more favorable for margins. Prices have been a little bit softer for the first half of the year. Henry Hub drifting back and forth between the mid $2 range to the low $3. Really, it's going to be just what they can do internally in terms of curtailing costs. You've seen the headlines about the job cuts for some of the bigger names. That's one method. Of course, there's other, production schedule, financial engineering that they can do. But ultimately, it's discipline, it's maintenance, and it's waiting for winter to kick in where they could get better pricing.
Fantastic. Thank you. Just a quick reminder, we hold these calls every Wednesday at 10 a.m. And so be delighted to have all of you join us again next week. I will also flag that we are all green dots on the terminal right now. We love to hear from you. If you've got any follow-up questions, shoot us an IB. Everything that we're talking about is based on reports that we've written that are available on the terminal. So if you haven't seen them, let us know. We're happy to sort of help you find the most rational way to navigate to those things. But Vince, let's come to you to close us out. Give us your read on 3Q. What are we going to hear? How's the quarter going to shape up relative to consensus?
Yeah, so production closer to flattish to slightly higher. Obviously, realized prices, both gas and oil and liquids, down year over year. So revenue stream is down. You have to make it up on the cost side. So that'll be some of the saving grace, but in general, earnings down year over year, quarter over quarter as well, for the most part, at least for the group that I cover on the upstream side. In terms of capacity for 2026, probably a little bit too early to give clear guidance for 2026. We should see that in the next, toward the late 4Q. Obviously, some companies provide more clarity, but in general, you'll still see that same disciplined, flattish budgets year over year. And with the hope of incremental synergies and efficiency gains, you'll probably eke out some margin aid because the price action doesn't look all that great on the oil side. Still have a lot of faith on the gas side that we can improve here from here. And the M&A synergies will also aid the margin too, but earnings will likely be under pressure for the foreseeable future.
Okay, thanks a lot, Vince. One last bit of marketing. I think most of you on the call, just scanning the list, are in our 2 client chats that are very active, talking about gas market, things happening with nuclear on down the line. So if you are not in those chats and you'd like to be, just shoot any one of us an IB. We're happy to help you get added. You can hear from not just us, but each other in terms of how some folks in the market are thinking about these topics. So with that, I wish everyone a great rest of your week and look forward to seeing everyone next Wednesday. Take care.
Thank you. Bye-bye now.